We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Avril in Singapore.
And I'm David Ingles in Hong Kong. Our top stories today, stocks across the Asia-Pacific are trading to the upside, but in a very tight range as a global relief rally loses some steam. Exhausted investors digesting the latest tariff talk out of Washington. Now, President Trump, speaking of, says the U.S. is in daily contact with China on trade, and a new tariff rate could come within weeks. But he is denying reports of possible changes to levies on cars and auto parts.
And I'm Stephen Engel, live at the Shanghai Auto Show, where we'll hear from company executives and also analysts as Chinese car makers look for markets beyond the United States for expansion amid Trump's trade war.
Good morning. Welcome to the show. We are seeing some gains still across risk assets. As you can see, we're up and being extremely generous here. A tenth of 1%. I think the story really is one where somewhat of relief, but still somewhat uncertain given given how we've pulled back from the edge. But beyond that, it's really anyone's guess how the conversation and headlines look this time tomorrow. All that being said, the S&P futures are continuing to see some upside. In fact, 5,400 right now on the most active contract. Just to note as well, South Korea did come out with some GDP numbers early on. If it, backward-looking indicators are any reminder of the sort of momentum or lack of it going into the current state we're in, surprisingly fell into a contraction rather, as far as the economy goes. Brent steady after the biggest drop in about, give or take, about 2 months or so. We're still trading at about 66 right now. Right. Flip the page, please, and have a look at how we are doing on gold futures. And we are seeing a bit of a bounce right now. Bottom of your screen is the ratio we've been tracking on gold and silver. We have pulled back from triple digits. 99 is still historically extremely elevated. We hit a 104 handle a couple of days back here. Right. Now, the approach to the open today, big move up overnight, and as you can see, big move across some of the big names. We'll continue to track that very closely. As we look at the approach to the open, A50 futures, a couple of changes to some calls coming through here, coming out of Citi. Well, Citi's saying it's time to accumulate property stocks. That's point number one. Point number two is when you look at what UBS is saying, so they've actually rejigged their weightings across the Asia-Pacific. And can we get the other board up, please, if we can? And what they're saying is Hong Kong, that's now down because that's exposed to the tariff conversation. They've upgraded India. We'll talk more about that in a moment. Dollar China, 730 right now. 10-year yield at 166. So, yeah, we are struggling for direction currently. But, we have 27 minutes to, I guess, Avril, get a better indication of how we'll open here.
Yeah, not sure which way to go, but we still have time till the open, Dave. But a couple of things we're also watching the Greater China region today, right? Not least among them, the stock rally from just a day ago, somehow coming in spite of these southbound flows, which really show Chinese investors selling Hong Kong stocks. And of course, we're going to keep close tabs on everything out of the Shanghai Auto Show. There's a Hong Kong dollar bond auction as well, a couple of earnings, including from Jiangsu Hengrui Medicine. Amid all this, of course, those tariff uncertainties, the things that we're really keeping a close watch on, Dave.
Yeah, 54. The name of the club, of course, I think Studio 54. No, that's also the number, I think, of companies, MSCI China companies coming out with earnings today. So stay tuned for that throughout the course of the session, as Avril was pointing out earnings. And it's really a time, since it's rather quiet on the macro front, and it could be, and I could be speaking to you soon, it might be time to a little bit pay more attention to fundamentals. But anyway, enough of that. Let's take a look at the changing tide of tariffs and the tariff conversation. President Trump says that the White House is having daily talks with Chinese officials in pursuit of a trade deal. Now, he also says a lower tariff rate could come within weeks. Now, here he is speaking at the White House a few hours back.
How soon do you want to bring the tariffs on Chinese goods?
Well, that depends on them. We just set the tariff. It's something that we think that will happen, I'd say, over the next couple of weeks. Wouldn't you say? I think so. Over the next 2-3 weeks. China has been judging us massive tariffs for many years.
Minmins here, our China correspondents. What do we take away from the latest comments there?
Yeah, it's been really confusing, right? Because Trump is now saying, well, for the first time, he's at least giving us a timeline. 2 to 3 weeks could be when we see tariffs come down. But bear in mind, Scott Bessent just yesterday was saying that it takes 2 to 3 years to iron out a trade deal. And Trump is also saying that the two sides, U.S. and China, have been speaking daily. But yesterday, Scott Bessent was saying that negotiations haven't even begun. So who is right? And also, we haven't gotten any indication from China that any talk of trade has been going on. China yesterday responded saying their door is open for dialogue and negotiation. It doesn't sound like they're knocking on the U.S. door, though. So a lot of questions here. And Trump also saying, while he is hoping to make a deal with President Xi, he says that if there is no deal, it's fine. So he's kind of walking things back a little bit, maybe a bit of damage control going on here, because we also have the White House press secretary saying that Trump is not being soft on China. This is not a unilateral offer from the U.S. to lower tariffs or to de-escalate, while Scott Bessent reiterated once again that those tariffs are unsustainable. So, yes, a lot of confusion, but I guess we at least have a milestone to look out for now, 2 to 3 weeks, to see if there are any progress on those tariffs.
Yeah, Min Min, and I think part of that confusion is also, even if they are having U.S.-China talks among officials, how high up the chain of command this is actually taking place among them. But what are we hearing when it comes to the potential new tariff rates? There's a lot of optimism that it might not be 145%.
Yes, Trump has hinted at that. He said it wouldn't be anywhere near 145%. And actually, Wall Street Journal had reported that the average tariff rates could be around 50 to 65%, according to sources. They are saying that the tariffs could be as low as 35% on certain goods that are not critical to national security, and as high as 100% on goods that are critical to national security. And this could be phased in gradually over 5 years. And we also understand that perhaps part of the reason why Trump may be backpedaling it a little bit is because he also met with executives from the likes of Target and Walmart. And these are companies that warned him about the supply chain disruption and the prospect of empty shelves within weeks. And that appeared to have resonated with President Trump. He also had met with the top 3 German automakers. And now we are getting news that the U.S. is proposing or considering to exempt these auto parts from additional tariffs. So those auto parts tariffs are still going to kick in May, but they might be exempted from the other cumulative tariffs like the fentanyl-related 20% and the steel and aluminium-related tariffs as well.
Ed, Min Min, you do your job very well and great clarity. Thank you so much, but I'm still confused. It's not your fault. How is it being covered in China?
Yeah, I mean, obviously it's getting a lot of traction in China as well. And we have a direct quote from President Xi this time on the People's Daily saying that these tariffs are basically hurting the legitimate rights and interests of all countries. I mean, we always hear this from China, but this time we hear it directly from President Xi. We also have state media Xinhua, for example, publishing a pretty scathing piece that was directly trying to rebut the argument made by Stephen Miran, who is one of Trump's economic advisor, who argued that U.S. military and the dollar are public goods that other countries should help shoulder the burden for. And Xinhua essentially is saying that this is the U.S. acting like an imperial power, trying to extract, some sort of tariffs or tribute from other country. There you can see the quote there, an imperial prerogative trying to make the rest of the world pay tribute. It's also saying that all of these problems in the U.S. is stemming from its domestic issues like overspending, overcommitment abroad, over-reliance on the U.S. dollar, imbalanced domestic spending. And here we have a Global Times article as well saying that the U.S. has not been sincere. It's saying one thing, saying that it wants a deal, but on the other hand, its actions show that it is applying maximum pressure on China. And it quoted this Confucius idiom, 听其言而观其行, meaning you have to listen to one's words, but also observe their actions. So the key here is, U.S. is all talk and not much action. And I also want to point out some of the interesting quotes that we have been seeing on Chinese social media, because this has been trending on Weibo, and the trending hashtag is Trump caved in. It's number 2 trending topic on Chinese social media. And here you can see one commentator saying his words cannot be trusted, he has no credibility whatsoever, and someone else saying his credit rating is so low he won't even be able to borrow a power bank in China. And this is funny because if you lived in China...
What's the context here? Yeah,
if you live in China, you will know that there are all these machines renting out power banks, and they're literally everywhere. Like almost every restaurant has it. It's very cheap. You don't really need a very strong credit rating. Everybody can borrow it. So this person obviously is saying that Trump's credit rating is down to the floor. He can't even borrow a power bank. And others also taking a crack at how Trump is crazy. Maybe he is making a fortune secretly through gold and U.S. stocks. The money is already in his pocket, so that's why his face is not important. That's why he can change his mind and make a U-turn now. And somebody else saying, does he expect China to say thank you? Obviously, this is a reference to the President Zelensky moment when J.D. Vance and Trump had been giving him a public dressing down.
All right. Yeah, 不用谢了. Okay. Min, thank you so much. Min Lo, our China correspondent there. And the reason also, just for our viewers too, right? The reason we're looking at Chinese media today, right? Because if we're struggling to differentiate noise from signal coming out of the other side, right? And, frankly, it changes almost on a daily basis. Chinese media is really a good window into an indication how close we are possibly to a deal once you see the tone and texture start to change. That might be perhaps a alternative indicator of the progress or lack of it on these trade talks at various levels. Right. Now, coming up, we're looking at Chinese car maker Nio looking to forge new alliances in Europe in the face of Trump's trade war. We are live to the Shanghai Auto Show next for an interview with CEO William Li, and we are counting down to the Open in Shanghai, Shenzhen, in Hong Kong. Futures are, for many of us in our 20s struggling for direction, as am I still, of course. 18 minutes to the opening bell. The Thursday session is just ahead. This is The China Show. Good morning.
Now, among the tariff headlines that we've been trying to distill, it also includes the auto industry. And President Trump says he's not considering changes to tariffs on autos and auto parts. And while most Chinese automakers don't export to the U.S., the subject of tariffs still looms over the Shanghai Auto Show. Our Bloomberg Chief North Asia correspondent Stephen Engel joins us now. Steve.
Yeah, absolutely. The available markets to the Chinese automakers is what's in focus, clearly, whether it's going to be Europe under a limited minimum price scheme that there's potentially negotiating, or it's going to be South America, it's going to be the Middle East, it's going to be Africa, other places other than countries named the United States. So that's what they're trying to figure out. And on this parts, tariff dispute, if you will, and back and forth from the White House, that's a very critical one, obviously, because China really does control the auto parts supply chain. It's going to be very difficult for American automakers to bring that supply chain back to the United States in any time quickly. And it's going to be very costly as well. So this issue of Trump, this was the Financial Times that was reporting that Trump plans to exempt car parts from part of his tariff scheme on China. The parts including the fentanyl, which was 20%, as well as steel and aluminum tariffs. However, the FT reports that the tariffs on auto parts from China would still be a part of the other tariff mechanisms that the White House has announced that, of course, have added up to 145%. So that adds to a lot of confusion, exacerbated even further when in the White House, in the Oval Office of the White House, Donald Trump clarified, he basically indicated he was not considering changes to those auto tariffs, while also suggesting he might even hike auto tariffs on countries like Canada. So again, I had someone yesterday tell me here at the auto show, you guys, meaning you Americans, keep on gyrating on everything Donald Trump says. We are just going ahead, making cars, building innovation, and finding available markets outside of the United States. So that's where we stand right now as we gyrate here on day 2 of the auto show. I mentioned about costs and Europe earlier. That is something that has been key to Nio, one of the, I guess you could call it the mid-tier Chinese EV makers. William Li is the founder and CEO. I caught up with him yesterday. They're kind of rethinking their strategy because of tariffs, but also because of the high costs and the high barriers to entry into Europe. They're rethinking their export strategy, but they're not shying away from it. Here's William Li.
In the next 3 years, our focus will undoubtedly remain on the Chinese market, as China is the world's largest and fastest growing market for smart electric vehicles, which is also the most competitive. As a company founded in China, we must secure a sufficient market share in our home market and achieve sustainable operations. This year, we have launched 9 new products. Our chips, for example, can increase our gross margin by 4 to 5%. Additionally, we are making significant efforts in managing sales expenses and enhancing the efficiency of R&D costs. Therefore, we are very confident in achieving profitability in the fourth quarter of this year.
So I know your new brand, Firefly, you're going to be concentrating on Singapore and other markets, including Europe, UK. How are you going to change the model there? Because you did go into 5 fairly expensive, largely Nordic countries in Europe, and you said you underestimated the cost structure there. So how are you going to change that cost structure at a time when there are tariffs as well?
Firstly, the tariffs will indeed impact our overall business plan. However, on the other hand, our new model Firefly is designed specifically for small car users. From a product perspective, it's very suitable for markets including Europe. The global market for small cars is approximately 20 million units. We will change our ways of cooperation. In the past few years, we have operated directly in 5 European countries. However, we will now collaborate more with local partners. We will have one partner in each country for long-term cooperation, leveraging their capabilities to expand our presence.
US is out of the question for the foreseeable future, right?
We set up our R&D center in San Jose when our company was founded in 2015. Over the past decade, we made tremendous investments in the US. However, it's quite challenging for a Chinese company to sell cars in the US. We must face a geopolitical reality.
How are you going to stand out in the domestic market? You're doing the battery swapping technology with the Firefly. Are you in active discussions with partners? I know you have talks with CATL, but others. Who are going to be those who help shoulder the immense costs of spreading across all the provinces in China?
We have invested in 3,275 battery swap stations in China for the past few years. This year, we have an even more ambitious plan. We aim to build battery swap stations in every county across the 27 provincial-level administrative regions in China. That means adding at least 1,000 more battery swap stations this year. This will certainly be a significant capital expenditure. First, we changed our approach this year by working with local partners in China, which will handle the construction of the stations. We have built partnership with more than a dozen companies. We will then rent the battery swap stations from them, which can help reduce our capital expenditure.
What's your take on news that regulators are going to increase scrutiny on self-driving and autonomous driving? You have NOP+, so how does that affect your development and rollout of eventually beyond level 3 autonomy?
We believe that reducing accidents and improving safety are the most important foundations of intelligent driving. That's why we primarily focused on enhancing active safety capabilities for the development of our end-to-end models last year. We are the first in the industry to establish such safety active system, creating a closed loop from vehicle data to cloud-based training.
Well, as car companies, Chinese EV makers like Nio navigate the realities of the geopolitical bifurcation between China and the United States, it doesn't mean that there's still not cooperation. BYD obviously is the overwhelming market leader domestically here in China, and they have a lot of cooperation with foreign players. Denza is their luxury EV brand here. Again, Mercedes was a big partner in that. They're no longer a part of that, but again, the lead designer for Denza and BYD is Wolfgang Egger. He's the former lead designer for Audi and Lamborghini. And you can clearly see the European lines in many of these cars, to the point that this kind of shooting brake style of the Z9 from Denza is prevalent in so many different Chinese car makers. It's very popular, but also it's raised concern and criticism that some of the Chinese cars, borrowing that European styling, are all starting to look very similar. Back to you guys.
Yeah, there we go. Steve, fantastic coverage there. Stephen Engel at the Shanghai Auto Show. We have more conversations coming up there with Steve, of course, on the ground for us there. Right, just going into the open today, the few bright spots, EV makers, among others, but most are actually slightly to the downside right now, so we are poised to open lower. That's a look at the EV makers, and we're looking at benchmarks right now to varying degrees of losses. A tenth of 1% on the tech gauge, and then we go down a little bit even further right now. So we are poised to open either slightly lower or flat. We'll see. 7 minutes away. This is the China Show. Good morning. Welcome back. So we're looking at U.S. futures, European futures too, following what was really a good solid day in the U.S. and even more solid day in Europe. Are we building on that? I don't know. If you squint, you might see a little bit of green. I mean, you will. If you squint some more, you might not see the 0.05%. You might get slightly misled, but I guess it's to some ways we got to spin it positively given the news flow recently. Very, very quickly, Hang Seng Tech, dollar China looking like this on your screens. Nothing much to tell you about, so I'll toss it down to Avril.
Yeah, I mean, we've been keeping a close watch on gold, right? Because amid the uncertainty, that seems to be the one thing that moves according to the news flow. And yesterday we saw these gold miners, they were the biggest drags in the CSI 300. Look at how they're faring today. Pre-markets look like we'll see a bit of green, so maybe that uncertainty feeding through into risk off again. Tourism stocks, take a look at how we are shaping up in pre-market as well, because we did get some data out of CCTV, and that showed us that climb, I think in domestic tourism, 19% it was in terms of spending. So certainly, they're kind of keeping it within the country amid all this. And, there's a bit of a mixed picture emerging, I think, when it comes to some of these stocks. But overall, looking like there is some optimism when it comes domestically. I mean, Dave, we've been talking about this, right? Which sectors do you kind of put your money into, especially given the uncertainties when you look at whether it's going to be the consumer staples or the EV stocks? UBS as a call. We'll talk more about it in just a bit. You're watching The China Show. The Open is next. This is Bloomberg.
Right, good morning. And just going into the open today, it's actually, might be speaking too soon, but it's been anything but boring of late. It's somewhat off that right now. And you know what? So Avril, this morning, I actually forgot to go into makeup, and our friends here on the floor had to pull me into makeup. And which I guess speaks to just the zombie-like state that we're in recently, following headline to headline. It also reminds me I got to do something about these eye bags. And if you're wondering why I'm wearing my glasses recently, these things have gotten too big. I can barely see now into my keyboard. But anyway, what's the open looking like today?
I mean, Dave, you among us, so many of us, not just in the newsroom, but I think investors overall, right? This exhausted state given the tariff headlines. And that's something we've still been trying to decipher. There's optimism, Dave, about maybe we don't see 145%, and maybe sectorally speaking, there are some exemptions of sorts or lower tariffs, whether you're talking about metals, so we're keeping an eye on them, commodities looking a bit firmer today. In terms of the open, we are seeing these Chinese stocks moving sideways. There is not much in the way of drivers when it comes to headlines, or maybe they're just not buying the news flow at the moment. We did get a call from UBS, though, amid these uncertainties, and we were just talking about this a short while ago, right, that maybe don't go into the EV stocks, go into those big established names with strong cash flow. So that means the likes of your consumer staples, Guizhou, Maotai among them. Flip the board, take a look at Hong Kong as we open up as well, because yesterday, despite those southbound outflows, right, Chinese stocks dumping Hong Kong, Chinese investors dumping Hong Kong stocks, I should say, to a near record amount, we managed to see gains on Hang Seng China Enterprises. But today, again, it's a bit of a reversal. Maybe speaks to the uncertainty we've been trying to distill among the tariff headlines. Flip the board again. We saw that relief rally yesterday, so maybe a bit of that reversal today, looking at gold and how there's a bit of a pickup, including on these gold mining related stocks, which, by the way, the biggest drag on the CSI 300 yesterday. Flip the board again. Amid all this, and we were just alluding to this a short while ago, Dave, the unknowns out there, maybe draw it back to the fundamentals. And that includes on the earnings front, right? And we have seen from the likes of SK Hynix, from Texas Instruments, that things maybe not as bad, looking quite good as well. Maybe some element of front loading, but it also makes you wonder, some of these concerns, are they a bit overblown in terms of the market reaction? So a couple of things we're distilling, and this is the mixed picture we're seeing among Chinese tech stocks today. Dave?
Yeah, it's a good time to be talking about earnings. You mentioned the UBS call, so you're kind of forcing my hand to talk about that, Avril. So the head of UBS China Fund actually betting on consumer stocks with haven characteristics, this sort of domestic focus, less exposure outside. We'll talk about the SK Hynix story as well. In fact, the perfect person to take us through all those different strands is our Asia Equities reporter, Sang-Lee Cha. Here with us to talk us through this. Why don't we start, Sang-Lee? Nice to see you, by the way. With the call coming out of UBS, what are they saying? What are they advising?
Yeah, so we've been seeing that among the MSCI Asia Pacific, consumer staples gauge was actually the top winner, coming from the Liberation Day shocker, right? But it seems like it's applying the same thing, the same logic in the China equity space. So UBS fund manager was telling me that actually the slow but steady winner is Maotai, and Maotai has risen just 1.8% this year, but it holds a super huge weighting in consumer staples gauge in CSI 300 index, right? So it has about 45% in weightings in that gauge, and it's definitely outperformed the CSI 300 benchmark. And so we're seeing that it's a haven play for China as well. But now that the tariffs de-escalation talks are here, a lot of these fund managers, including UBS, is seeing that China is becoming a lot more attractive, and so all these pockets of the sectors are looking quite interesting, but especially those consumer staples and perhaps discretionary as well. But right now, a lot of these names like Xiaomi or BYD, a lot of those that have rallied so much could be a little bit difficult because they are competition can come anytime, and then that would actually result in a drop in those shares. That's what the fund manager has been telling me.
Yeah, that's interesting because, I mean, just to clarify as well, because there's a separate UBS call from the sell side on an Asia-wide call, right? So I think they're upgrading India. This will make sense in a moment, Sang-Lee. They've downgraded Hong Kong, right? Some of the things that have rallied. The market here in Hong Kong is exposed to global trade. To the point you're making, they do still prefer China over India on better risk-reward. The reason I bring Hong Kong and China up and juxtapose that is that we saw a massive amount of selling across the Stock Connect yesterday.
That's correct. And that's been a stark contrast to what we saw 2 weeks ago, which was the southbound money snapping up just a record amount of Hong Kong stocks. And usually we have seen this southbound flow, these mainland investors come in and put a floor to those sell-off, especially during the Liberation Day tariff announcements, and also, so they would come in and to really buy the dip. But what happened yesterday was exactly the opposite, where they saw the stocks rally and then they took profit. And they dumped about 18 billion Hong Kong dollars worth of stocks. That's about $2.2 billion we're talking about. And so some are saying that, now with the de-escalation talks, they're saying that this is maybe the best opportunity to actually dump the stocks.
Speaking of opportunities, Sang-Mi, we've also been seeing SK Hynix. I mean, its earnings showing that strong AI demand and boosting, the outlook as well, I think. But what element of front loading is feeding into this? And how is that playing out in terms of the stock? Because it's only risen, I think, what, 4% so far this year?
Yeah, so SK Hynix reported earnings today, and it was better than expected. It was what market had expected, actually. But going back to March 31st, that's when South Korea lifted the short-selling ban on its stocks, and that was a months-long ban that they lifted. And we have seen that we were able to track that it's heading to the record monthly short sales for SK Hynix stocks. Investors have dumped around 1.5 trillion won. That's about $1 billion worth of stocks, and separately 2.9 trillion won of overseas investors have sold those shares. And a lot of the traders are telling us that the reason behind it is because, of course, there was that HBM rally, HBM chip demand that, on the back of that artificial intelligence spending, but that's slowing. So a lot of that outlook that's looking a little gloomy is impacting this memory maker. Yeah.
Sang-Mi, fantastic. Thank you so much for wrapping up all those strands for us. Here on sets in Hong Kong, our Asia equities reporter Sang-Mi Cha. Let's talk more about this. I want to say China, but it's really a global story, this pivot away from dollar assets. Let's bring in Ju Wang, head of Greater China FX and Rate Strategy at BNP Paribas. Ju Wang, I hope you don't mind if we start with the U.S. and this sort of de-dollarization theme. Are you getting questions around the dollar recently?
Definitely. I probably received the most de-dollarization questions in my career over the past couple of weeks.
Okay, so what's the question, and do we have enough information for an actionable answer?
The question is really about if we were worried about further escalation about the trade war between U.S. and China and the rest of the world. Should investors move away from the already very, very overweighted, dollar assets? And if they do so, what are the alternatives?
Okay, and so what is it? Because we certainly have seen money come out of treasuries. The risk premium that's been built into treasuries, I believe, is at a 2-year high. We're not sure who's selling. We're not sure where they're taking their money. So what's your sense of what flows are telling you?
We sense the weakness is mainly driven by, first of all, the positioning. The market been trading on the U.S. exceptionalism for more than 2 decades, right? So the positioning in both U.S. equities and treasuries are very, very high. Not to mention the past 3 years, we're being in the high for longer regime. A lot of the surplus economy, especially Asian ones, are putting their excess savings in the U.S. treasuries. So the positioning itself is very, very high. But it come at a time where markets start to question the U.S. future policy room, given this fear about stagflation. The trade war will add to inflation concerns in the U.S. side at a time where everyone kind of feel that the fiscal policy has been somewhat utilized during Biden's administration. So Trump is dealing with a tighter fiscal situation in the U.S. at a time where inflation does not allow Fed to quickly enter into an easing cycle. So that constrained the Fed put. So we usually have a Fed put when there's a trouble, but now that Fed put kind of is somewhat shallow. And that's why the market is moving away from the U.S. assets. They believe other economies may have better policy rooms, for example, Europe.
Ju Wang, what's your sense of, we've seen how Trump's been targeting the Fed chair, even though this week some of that was walked back. And there is a sense of whether this makes things worse in more ways than one, not just because, there's no certainty about potentially the Fed's autonomy, but also, does this also derail the signs of investor confidence on the Fed's ability to kind of rein in inflation? What are some of the implications that you're looking at here?
I do think the U.S. administration pays a high attention to the U.S. Treasury risk premiums because, first of all, they are under a tight situation regarding the fiscal room. At the same time, they understand the U.S. Treasury plays an important role in the financial stability in the U.S. market. So we kind of see it's interesting every time when the 10-year U.S. Treasury surge to the level that the market getting a bit itchy, they will kind of step back regarding their kind of trade policies, right? So the overnight shift about moderation of their trade stance and talking about potential eventually there will be a deal between U.S. and China has sent market some sense of relief. But we do think that in the medium term, we also have to respect that Trump is taking his tariff policy seriously, and literally there's a high chance. Even though our base case is that there will be negotiation between U.S. and China, there will be a rollback on the current extremely high tariff levels. But our base case is this tariff will only be rolled back down towards a 50-60% level. That's exactly what Trump has promised during his presidential campaign.
So maybe some reversion to what initially markets thought it was going to look like, what Trump suggested. But you also talked about how there still seems to be a bit of a lack of alternatives. When the dust settles, what is your sense of euro dollar, dollar yen?
We acknowledge, yes, there's still a lack of alternative situation for the people who wants to move away from the dollar. But we're also thinking there's a couple of interesting development, especially out of the Europe. We know that after the German election, the Europe has essentially heading towards one of the most aggressive fiscal easing policy for the next couple of years. And BNP expected the 10-year German bond yields to gradually rise towards 3.8% by the end of 2027. So that does, make the European fixed income as a viable alternative for the U.S. assets. It takes time, but it does provide some hope. At least you can reduce your dollar holdings back towards European assets. And that's also the feedback we got from the Asian clients. They definitely think the Europe, the yen assets and some other G7 assets provide alternative towards the U.S. assets, not only because of positioning, but also because of European fiscals, but also because the U.S. side currently is facing a bit of policy constraint in both monetary and fiscal policy side.
Yeah, there we go. It might make political sense. It certainly makes tactical sense. Ju Wang, of course, stays with us for a couple of more minutes. So if you have any questions for her clients, of course, get them in. You know how to get this through there. Right, plenty more ahead. Looking at markets, slightly bid across most of Asia, not all volumes on the lighter side. A look at cash markets. No way to describe it, but mixed. Plenty more ahead. This is Bloomberg. Right, welcome back. A glance at currency markets right now. So dollar China is on the weaker side. Well, yuan is on the weaker side of 7.29 right now. You can look at the rest on your screens. We've been waiting for some action coming out of Chinese monetary and fiscal officials. Really, we've been waiting. So far, nothing aggressive. But certainly when you look at swaps, they are pointing down. You look at risk reversals, maybe suggesting some weakness ahead in the currency. Let's bring back in Ju Wang, head of Greater China FX and Rate Strategy at BNP Paribas. I'll see if my producers can bring up this chart, Ju Wang, so we can talk about this. Guys, it's chart 1911. We're trying to figure out how low and weak the currency can get, and on a basket basis, say. Do we get back to, because we're almost at 2-year lows, do we get back to the previous trade war lows, though? And what would be the indication of that as far as policy goes?
We actually think there's a high probability for the CFAX index to drop to the 2018-19 trade war lows, i.e. 91, 92-ish level. But a large part of that is driven by the euro dollar. Because the euro weighs and how much other currencies being looking at the euro dollar. So BNP's view is euro is going to gradually rise to 1.2 by end of next year. So there's a high chance by end of next year when euro is trading at 1.2, the dollar RMB is still going to be hovering around current level. And by that time, I think the CFS basket will drop to the 2018 and 2019 low.
Okay. That's important because that's going to be the cause of this and not what most people expect. The other part I want to ask you then is, why haven't we seen aggressive policy direction or action? Let's put it that way. We know where direction is, but we're looking for action here out of officials.
Absolutely, we understand that. We were asked by a lot of clients about why so far there's seemingly lack of action just yet. We think that if you pay attention to the headlines, the presidency actually went to Southeast Asia to visit various countries. So that tells you where the priority is. China has a very highly competitive manufacturing sector. The exports is very competitive. So to be honest, even during extreme cases, if China's trades with the U.S. drop to zero direct trades, China is still going to run reasonably high trade surplus with the rest of the world because of the competitive capacity side. So the importance for China is to ensure the relationship with emerging market as well as Europe to stay intact despite of this trade war. So they can survive the trade war okay. So I think the priority currently is to ensure trade relationship with other economies to stay intact. But we do think that the stimulus is going to come. By end of this month, we're going to have the April Politburo meeting. Chances high they're going to start to implement some of the stimulus they promised during March MPC. And then they will wait and see the negotiation result with the U.S. Our base case is that there will be rollback of the tariff by end of Q2. But if the situation is worse than expected, we probably will see a step up in terms of stimulus in second half, especially after the July Politburo meeting.
Chu Wang, since you mentioned China maybe keeping things smooth in terms of its trade relationship with countries in this part of the world, Southeast Asia including, what is your sense of the element of how concerned some of these economies might be of the dumping of Chinese goods, right? Obviously, now it might not make sense for them to sell to the U.S., China that is. So, does that affect potentially some of these currency moves if the likes of, Southeast Asian countries maybe a bit more cautious about how much Chinese goods they take in?
Yes, there's certainly a concern about China dumping goods towards Asia and Europe if they cannot export to U.S. And we are seeing a lot of Asian central banks, including ECBs, being in a monetary easing mode since Trump's winning the election. And they're already preemptively, act to in anticipation of some kind of tariffs. But we don't think China is going to dumping goods to this country. We do think that the message out of the Xi's visit to Southeast Asia is that there's still a lot of high value paid towards bilateral relationship between China and these economies. At the same time, I think both sides understand the longer term cross investments is important, and China has pledged to continue encourage corporate outbound investment into Southeast Asia as well as Europe. And yesterday we saw PBUC's conference came out pledging to give financing resources to such kind of outbound investment needs. I think Europe is also understanding that. We're seeing various headlines that European is welcoming Chinese electronic vehicle companies to come to Europe to set up local productions to produce. They all understand that China benefited in welcoming FDIs for the past couple of decades, and now we're kind of in a reverse situation, but more Chinese outbound investment into the rest of the world will partially offset the concern about tariffs and trade wars in our view.
Ju Wang, thank you so much. Fantastic. We've covered everything there, including, I think, the underlying trade links like China is looking to strengthen. And then maybe the reserve currency thing just happens naturally. We'll see. Ju Wang there out of BNP. Right, if you're one of our Bloomberg clients, you can catch that wide-ranging conversation we just had there with Ju Wang on TV Go. Scroll back to the show and other things that you might have missed throughout the programming today. Plenty more ahead. This is the China Show.
Now for another check of the markets, there is one that we've been keeping a close watch on. TNC Lithium, after it swung back to profit in the first quarter, we're seeing that shares really surging ahead, well over 7%, returning to profitability, as I say, in the first quarter. And of course, comparing this with a net loss of about 3.9 billion yuan from a year ago. So things looking quite healthy when it comes to sales of lithium compounds. The other bunch of stocks we're keeping a close watch on, these crane makers in China after the US planned more duties, and this is despite no US industry for this in terms of equipment existing. The stock's down at the moment.
Right, welcome back. You're watching the China Show, about 29 minutes and nearly 30 seconds into the cash market session. Just off session lows a little bit on the Hang Seng Index, still down for the day though. Most constituents are down. You have a few bright spots within the EV and car space. Of course, that's just my way of saying it's not all bad, and it's also my way of saying that we'll be live, of course, with Stephen Engel, who's been covering the Shanghai Auto Show for us. In terms of net flows across the Stock Connect, massive amount came out yesterday, 18 billion Hong Kong dollars, which I think was the second most on record on a daily basis. We're seeing some money come back in today. We're looking at the Asian chip space. You had SK Hynix reporting quite a beat there as far as revenue goes. So just a glance at that too. It's really a chance for us to also focus in on fundamentals, right? So we talk about earnings, SK Hynix. When you look at the rest of the Chinese market, it's worth pointing out, I think we have just over 50 MSCI China companies set to report earnings today. Right, VIX futures, let's have a look at that. To what extent have we pulled back from the brink? To what extent have things de-escalated? I think one good measure of that, not obviously an exhaustive one, is when you look at the VIX. So it's quite clear when you have Liberation Day, April 2, April 3, depending where you are in the world. So we retraced most, not all, at current levels. We're effectively back to just days after that point in time. But we are still, as you can see, we still have a 20-25 handle. That's still fairly elevated. Just a very quick glance across other things happening as well. So you had a big drop in Brent crude yesterday. We are seeing some stability there as far as that's bottom row rightmost side near iron ore. And we'll talk more about the Nikkei, right? So dip buying, what's going on in Japan? And US 2s and 10s on your screens for you there. Avril.
Yeah, what's going on in Japan is something, or among the things that we want to talk to Bloomberg MLife strategist Mark Cranfield about, Dave. But first off, with us in the studio for some analysis, Mark, we have, come off this period where Dave was just talking about how the VIX dropping to a 3-week low, but it's still that specter of volatility. Investors, people that track the news, exhausted, right? How sustainable is all this? How is that going to shape things for time to come?
You still have investors? I thought they'd all run away. I thought they finished with it.
The brave have stuck through
okay.
it, yeah.
So those brave investors, what is really unnerving them? Our colleague in New York, Cameron Christ, who's better known as Macro Man, you may see his daily newsletters. Last night he was talking about the realized volatility for the S&P 500. It's currently running around 60%. The only times in history when we've seen volatility like that is in the 1930s, Wall Street crash, and in the global financial crisis. This is not something that many investors can cope with. When they see those kind of reactions, those kind of numbers, they just want to head to the sidelines. Say, how do you make decisions based on your portfolio when you've got 60% volatility. That is just too much to take in. And it's too dangerous as well, because also your risk managers are going to be telling you, these markets are moving too crazily. You need to just get to your minimum amount of risk that you can and then just move away from it. Don't lose any more money, because it's just too dangerous in this environment. So that's what investors are having to cope with. And if you're a multi-asset manager, it makes it even worse, because then you're having those volatilities spreading to other assets as well. And to confuse the matter even more, you've got the US dollar equities and treasuries were falling all at the same time. So there's no haven play for somebody who's dollar-based. You have to switch somewhere else. So you put all those things together, it's no wonder that people are stepping back and saying it's really too confusing for me to make decisions here. I would like to see some clarity on where trade deals are going. I would like to know whether they're going to be imposed in 90 days or at all. Is the Federal Reserve really independent? Can we trust them any longer? Is the US credit rating going to be lowered this year or not? All of those kind of big questions will be coming into play now as people hope that volatility will decline. But when you see that we're reacting to almost minute-by-minute headlines, it's very hard to see how we're going to get volatility down to a more manageable level.
Amid all this, we've been seeing investors really just turn tail on US assets, right? They're like, I'm done with this. And they've been turning to the yen or the euro. So we've talked a lot about these FX moves, but you're highlighting what's happening in Japanese stocks as well, including foreign buying. What's going on there?
Yeah, interestingly, because last year, foreign investors were not a particularly good indicator for what's happening in Japan. In fact, they tended to be a reverse indicator. They finally got their timing right. Their dip buying this month has been very good. It almost exactly coincided with the low for the Japanese markets in the first week of April, and they've been successfully buying since, and quite decent amounts as well. So the net inflows for the last 3 weeks in Japan have been pretty solid, coinciding with the rally in the Topics index. Actually is now slightly above where it was when Liberation Day hit. And this is happening at the same time when Japan, the yen on a trade-weighted basket has actually got stronger this month. It's also a bit stronger against the dollar, but more importantly, it's stronger against a basket of currencies. And yet still, foreign investors are putting their money there. That is a clear sign that people see the move away from the US dollar as sustainable. The fact that they're willing to put decent amounts of money into Japan, even as the yen is getting stronger. It's no longer a case of Japanese exporters can't cope with it. They're showing that they can to some extent. They've lived with a strong yen before, and people expect they will be able to again. Toyota will announce its earnings in about 2 weeks' time. That will be a very good signal to see how Japanese automakers are adjusting to the new environment. But for the time being, it looks quite promising. Foreign money is going back to Japan.
Yeah, and Mark, I think the UBS had a call, which they've changed, I think, twice in recent weeks on dollar-yen. They now think 130 on dollar-yen. Mark, so I think that to build on what Avril was just pointing out and what you guys discussed, so we've been seeing some pressure on the dollar, and we understand the reasons why. What do you suspect the forex reaction will be once we start to get, and hopefully we get to this point, right? Once we start to get more positive developments, that the trade deal is nearing?
I think what you've seen happen over the past few weeks is irreversible, largely. The questions on the credibility of the US financial system, US assets, has just run too deep. And investors are seeing that there are opportunities elsewhere. We still haven't even reached the point yet. Don't forget, Moody's rating agency still has the United States rating on a negative outlook. They will probably have to make a decision some point this year. If you look at the way the steepening of the yield curve is going in the United States, that's telling you that traders expect a downgrade in the United States credit rating. Because it's something that happens so rarely, it can still have a market impact, even though it's something we probably expect would happen this year anyway. But it will still be a shock to people if it comes. The moves, people moving their money, the US is a reserve currency, it's still the biggest reserve currency, but the numbers are getting slightly smaller. And the shift away to the euro, to the yen, to the Swiss franc, that money is probably not going to come back to the US dollar anytime soon, particularly because we don't even have US midterm elections until more than a year's time. Investors will be assuming that the political stance in the United States will stay pretty much as it is, at least until the midterm elections in 2026. That's a long runway. From an investor's and a trader's point of view, that's far too long for them to be making decisions that maybe I'm in, maybe I'm out. They have to commit themselves. And they've probably decided, I want some of my money away from the US dollar, and it should stay there for quite a long time.
Mark, thank you. Mark Cranfield in Singapore for us there. Now, let's get a sense how near we are, in fact, at least compared to yesterday, to a deal. The softening of the stance certainly is a narrative that has formed ever so slowly and calcified, let's put it that way, this week. So far, so you have President Trump saying his White House, his administration is having daily talks with Chinese officials in pursuit of a trade deal. He also says a lower tariff rate could come within weeks. Min Lo, our China correspondent, is here to just help us make sense of what the president is saying, and we're hearing somewhat slightly different comments coming out of his Treasury Secretary. And do we meet in the middle for clarity?
Yeah, it's been really confusing to keep track of all the comments coming out of the White House. So President Trump is saying that those tariffs could be lowered within 2 to 3 weeks, but Scott Bessent is saying it could take 2 to 3 years to reach a trade deal. And Trump also saying that the two sides, China and the U.S., have been having daily conversations, but we haven't actually heard something to the same extent from the Chinese side, though. And also, Scott Bessent also mentioned yesterday that talks have not even begun with China at all. That was just yesterday. So a little bit confusing, and also Trump saying this time that while he is hoping to get a deal with President Xi, now he's saying that if the deal doesn't happen, that's fine. So a little bit of backpedaling from yesterday, and maybe it's also trying to do a little bit of damage control to not show Trump as the one to blink first in the staring contest, because we have the White House press secretary saying that Trump is not being soft in China. This is not a unilateral offer from the U.S. to de-escalate or lower tariffs, and that's despite Scott Bessent once again reiterating that those tariffs are unsustainable. So really hard to say where things will go from here. And we have the Chinese side responding yesterday saying that their door has always been open to dialogue and negotiation. It doesn't seem like they are the ones to come and knock on the U.S. doors, though. So who's going to start the ball rolling? That's still the question.
Yeah, and I think it was just last week, so I'm losing track of time now, where the Chinese side said they were asking for two things: some respect and give us someone to talk to specifically.
Yes.
Have we seen any progress in that? And again, the other thing I want to ask is, how are they likely to respond, if they will respond, to the latest rhetoric coming out of the White House?
Yeah, I mean, if you look at what happened yesterday from the Foreign Ministry, they simply reiterated the same lines about their doors being open, but they don't want to fight with the U.S., but if the U.S. wants to fight, they're going to fight till the end. So really, throughout all the twists and turns of this tariff war, China's stance has been extremely consistent, and nothing has changed in their message so far. And I'm not sure the ball is really in the Chinese court now, because you think about it, nothing has changed except all these comments from Trump. They're really just sound bites. They haven't really taken any concrete actions to offer something to China in a way that would entice them to come to a deal. I mean, nothing really has changed aside from all this talk. So I don't know, I guess from the Chinese perspective, they're still waiting for the U.S. to make the first move, because their perspective, from what I'm reading from all the readouts from the Chinese Foreign Ministry, is that all of this started because the U.S. created this, inflicted all this pain on themselves and others, and they want the U.S. to be the one to reach out first. So we'll have to see if Trump's administration actually offers something tangible that could move, speed things along in 2 to 3 weeks' time.
Min, thank you so much. Min Lo, our China correspondent, they're really a good context. And I think if you look at the template that we had for the Japanese and the progress we saw there on trade talks, I mean, we're nowhere near even stage one of that, right? So we know that we've been told that there are conversations taking place. We're not sure at what level. Certainly not at the level that would indicate progress is being made. Certainly we're not aware of any sort of trip so far on either side. Right, let's continue the shows here. And coming up here, we're looking at cars, really. And something I do when I feel lost and dazed and confused. I sit on the sidewalk and look at cars. That's what we'll do next at a Shanghai Auto Show. Plenty more ahead. This is the China Show.
Checking in on these EV makers here on the China Show. I mean, a couple of drivers pardon the pun. You're looking at the concern about potential tariff impact, if at all. Also, whether, these EV makers in an incredibly competitive landscape are able to push out the best possible product for buyers. And you think about battery technology, how the likes of Xiaomi, BYD, they've really been, pushing the frontier. Today, maybe part of a bit of bucking the trend. Somehow we're seeing a lot of gains and the attention also there because of the Shanghai Auto Show. And we're also focusing on another Chinese brand, Jetour. It says it's currently not impacted by tariffs, but is still preparing for any future adverse effects. International President Chuandeng spoke to us at the Shanghai Auto Show about how Chinese consumers are changing their approach to buying cars.
I think now in China market is changing very fast. First is about the energy. So in China, now China is leading the new energy cars development in the world. And now in China, the new energy market shares, the penetration is almost half. Yeah. So it's leading the new energy development in the world. So now the market is changed. And secondly, because the car, I think that it used to be a tooling for the working, for the daily transportation. But right now, it's not only for the work, for the transportation. It's for lifestyle. So, for example, for our cars, for Jetour, we aim to create the travel plus culture for the cars industry. It means that the car is not only for working, for transportation, it's for life. So you can travel, you can enjoy the life, you even can sleep in the cars, work in the video in the cars, and then you can do everything with the cars. So it means that now everything is changing in China. So Jetour as a new brand, we try to lead this transformation and try to create a new concept of the car industry in the world.
So in the time of higher tariffs, is local production more important? I know that Dashing, you're going to be having local production in Malaysia, right? Already. So is local production in your markets that you want to go outside China important, or will you just mostly rely on exporting?
It depends because it depends on the marketing size. So if it's a very huge market, huge size, it's more possible, it's more economical to make a local produce. And secondly, it depends on the local requirement. And some of the authorities request you must to have a locally production. Otherwise, you cannot have the importation license. Yeah? And some of the market that don't need the CKD producing locally because they don't have the infrastructure for that. They don't have the industry to support. So I mean that it depends. But I think that will be the future, more localization.
Since you do export, you're, I believe, going to Philippines, Malaysia, Indonesia, Russia, Egypt, some Middle East, South America, right? So parts and also exports to a number of these countries. How are you acutely impacted by the trade war?
I think that we are not suffering very, very tough, because first of all, we have our how to say, because right now the business is going well, and we are not suffering by the trade war, because now Jetour, we are not going inside the United States.
Any plans for that?
In the future, maybe 3-5 years later. And also for the European market, but now we have a very good relationship with the European. They just release the restriction for the BEV cars importation to Europe. So right now we are export mostly to Middle East, to CIS, to Asia, to Latin America. So right now we are not suffering for that, but we are preparing for that if anything happens in the future.
There we go. Stephen Engel, hard at work there at the Shanghai Auto Show. We have plenty more, of course, coming up on shows from him there. And it really, as Avril was pointing out, it's really one of the, I think, very few sort of sources of tangible news that the markets are latching onto at this point in time, given just generally it's been a quiet market so far. In fact, we'll have more coming out of the auto show in a moment here. We'll be speaking with the global leader of the automotive and industrial practice at consultancy AlixPartners. That's coming up next. This is Bloomberg. Right, welcome back. We are still talking tariffs. We're looking underneath the hood, though, and really looking at plans among Chinese companies amidst what currently look to be very decoupling level tariffs. And if things improve, what's the plan? What's plan B? And some have actually, in fact, given up really on the U.S. market. In fact, that's really one of the top pieces, main topics for one of the stories we put out today here at Bloomberg, that many exporters are actually just halting their shipments altogether to the U.S. because of these tariffs in place or the uncertainty that it's forcing them to really withdraw from the market. In fact, let's bring in our China government and economic reporter, Lucille Liu, who joins us from Beijing. And yeah, Lucille, give us a context. You guys have been very busy talking to exporters of goods. What types of companies are we talking about that are maybe just giving up on the U.S. market specifically?
Yeah, no, we've been traveling to Guangzhou. We hit the Canton Fair. We went to Xin Village, and we're surprised by the number of companies that told us that they're just giving up because some of them not out of choice. There's one yoga hat maker which said that basically they're hiking prices of their existing inventory and then they're focusing on other markets because this is just too unpredictable for them, and it's a strategic decision. For others, like some of the factories that we saw in Xin Village, there were just these tiny mom and pop shops. A lot of these places, if they don't get an order, they have to close down. They need to pay their workers, they have to pay the rent, and if they're depending on the export markets and they're not getting those orders, then they really have no choice. So yeah, a lot of companies focusing on other markets, looking to do more trade shows in Europe, in the Middle East, and yeah, just finding other buyers for their wares.
Lucille, you provide really good color on what these exporters are perhaps, looking to do or not do, given how they've given up on the U.S. But, in terms of the markets that they're exploring, what are you seeing? Where are they turning to? You alluded to some of this just a short while ago.
Yeah, absolutely. I mean, so we had people tell us that, they've been aggressively, they're no longer doing business development in the U.S. They're going to Europe. But I think the big problem, of course, is that, the U.S. is just such a huge market. One person told us, they've been hitting up Europe hard, but at the moment, it's basically 10% of what the U.S. market was to them. So it's a slow build, and they're going to have to do a lot more business development. But and then there's obviously a lot of companies also just trying to go to Southeast Asia, go to factories in other places in order to reach the U.S. So they're very flexible. Everyone's trying to find workarounds. But for the moment, I think there are some companies that are just pulling out of the market. That's going to have an impact on prices in the U.S. And basically shelves that won't be stocked with items that were there a month ago.
Lucille, great to get your insights and your reporting on all this. Lucille Liu, Bloomberg China government and economic reporter. And now to some of the major corporate headlines we've been following. Amid the tensions between the U.S. and China, Boeing is saying it's prepared to find alternative buyers for around 50 of its planes originally bound for China that are now stuck in a trade dispute with the U.S. CEO Kelly Ortberg says the company is in close communications with its Chinese customers. The plane maker reported a first quarter cash burn of $2.3 billion as it ramped up jet production, well below the $3.4 billion expected by analysts. Meanwhile, TSMC says it plans to begin production using its cutting-edge A14 fabrication process in 2028. Company executives say the new technology will help improve power efficiency and performance. TSMC remains confident industry revenue will top $1 trillion by the end of the decade as AI chip designers embrace new production technology. Plenty more ahead. Stay with us. This is Bloomberg.
Right, welcome back. We're just going into the Japanese lunch break. Lots of news to tell you about, from automakers to pullback maybe in tariffs, possibility, question mark. And we are also looking at some inflows coming through. You can read about that on your Bloomberg terminal. Care of Mark Cranfield talking about how foreign investors have been buying this Japanese dip, up 1%. Just looking at Nintendo, lots of strands across this Switch story today. So from the company itself, and I'm going to circle back, and this is all going to make sense, hopefully, for you guys. And I can't stop thinking about what our reporter in the last segment talked about, how their visits to Chinese factories and expensive yoga pants just reminds me how expensive Lululemon yoga pants are. In fact, I'm just looking at the Lululemon website. I like the tagline, by the way, just dropped, new dresses and your jaw. This is going to make sense in a moment here. So the Switch from Nintendo, Switch 2, $450, right? For people that are complaining that Lululemon charges you about $500 US for a 600 downfill parka, stop complaining, because the Nintendo Switch is equally as expensive, if not more. Anyway, Nintendo's saying there's an overwhelming demand, and just to shoot your hopes down in that, our folks at Bloomberg Intelligence, the reaction piece there, and to take it back to the tariff story, just a segue to Avril here, is that the prospects of the Switch 2 might be blunted because of U.S. tariffs. There we go, just to get all those stories in, plus of some thoughts from my own. Avril.
It's clearly quite a skill, the way you managed to tie these trends together. But, you know, it's also interesting. I mean, amid some of these losses for investors in risk assets, maybe they're turning to premium products such as the Switch, such as Lululemon pants, to make them feel a bit better about all this, right? So to your point about when it comes to tariffs, it's interesting we're seeing how, you know, sectorally speaking, a bit of consternation from the auto industry, certainly, and that seems to be also maybe feeding into what the Trump administration is considering here. So we're hearing that these U.S. officials are thinking about easing these tariffs for the auto industry. We're seeing a surge in the Japanese automakers today, led by Nissan, Toyota trailing not far behind, but it's also a bit tricky to kind of track the cross currents, because today we know how the yen has been giving up some of these gains, which typically fuels these export-related names as well. But speaking of autos, let's head back to the Shanghai Auto Show. Stephen Ingles standing by with our next guest.
Yeah, well, this tariff story obviously is front and center on everybody's minds here at the Shanghai Auto Show for the last couple of days of the press day. And let's get right to the latest issue. Obviously, we've gotten different reports all throughout the morning about whether the White House is going to give an exemption to the auto industry and auto parts. Obviously, China is the dominant player in the auto parts sector that many in the European Union and also in the United States rely on. Let's get more on this and all things auto with Andrew Bergbaum, AlixPartners global leader of the automotive and industrial practice. Thanks so much for joining us. So first of all, what's your first take about what's front and center of everybody's mind here at the Shanghai Auto Show? There's resilience and also kind of finding available markets. What's front and center in your mind right now?
I mean, confidence would be a word that I would use. This is just immense, this show. 1,000 companies here with 100 new launches, brand new product coming to market, really for the global market. Speeches being done in English as well as Chinese. So this is really a show where China and Shanghai is really broadcasting to the world that it's a dominant player in this industry.
How critical to the global automobile supply chain would it be for Trump to ease off and show some leniency on the auto sector?
Well, of course, it would help immensely. If we talk about North America, the tariffs on vehicles and the parts tariffs on vehicles will make a very, very real impact to the cost of a vehicle in the market. And of course, that's huge. So, of course, that will make a very big difference, really, to sales in the US. But, of course, everybody's affected, including the European Union as well.
Well, it's a very difficult challenge for the American automakers. They are here. I mean, General Motors is here, Ford is here, Tesla is not. But essentially, you know, everybody I've been talking to is saying, how are they going to assume and essentially absorb the shock of rising prices if they're going to be tariffing the supply chain in the automobile sector, which is dominated by China?
Well, by definition, the sales will go down in North America. So we'll start to see the consumer actually not being able to afford the products themselves. So really some leniency would make a very big difference to those things there. It's really clear that sort of trade imbalance is going to affect the industry in a really quite large way.
What are you hearing about the available markets outside of China for the Chinese EVs that are not named the United States? Obviously, they're going elsewhere. We saw Chinese exports of EVs rise, and automobiles as a whole rise more than 7% last year. So they are exporting, even though the United States and also the EU have put tariffs on.
I mean, they're exporting in a really big way. They're twice as big as their nearest competitor, which is Japan, and they'll be approaching 7 million vehicles that will be exported. It's not just EVs, it's ICE cars as well. But of course, the Russian market has become a really big market for Chinese vehicles.
Russia and Middle East.
And Middle East as well.
Yeah, and BYD, we're here at BYD. They are a major player here, right? So they're kind of setting the market, aren't they?
No, absolutely right. I mean, 1/3 of the vehicles going to the Middle East or Russia, and just about 20% going to Europe. So these are really big export markets for the Chinese producers.
What's your take on the foreign participants here? They are here in large force. Nissan is right here. Toyota is here in force. I mean, there's some potential consolidation going to happen in the Japanese market. Where do you think the Japanese weigh in on this as far as the opportunities? Well, they're dwindling. American opportunities in China are dwindling. What are the Japanese opportunities?
Well, they have a lot to lose in the Chinese market, which is why they're here in force. And the products they seem to be bringing here really are a quantum leap on where they've been, whether that's electric vehicles or actually the cockpits or the intelligent driving. The Japanese really have making a statement over the course of this show with the products that they're bringing, but the Europeans are as well, with brand new launches, using Shanghai as the way to launch brand new vehicles. This might be the year that the more traditional automakers try and strike back with bring themselves back up to the Chinese standard.
But this also might be the year, according to Bill Russo and others, that in China, new energy vehicles, electric cars, essentially outsell the traditional internal combustion engine models. This will be the year.
Well, our prediction is 54% of the sales will be new energy vehicles. But by the time we turn the decade, it's going to be 3/4. So yes, this is the year where we will start to see that real flip.
Is it game over in China for the GMs and the Fords, the American car makers, as they knew it?
I think there's still work to do here because the brands still have some value. But of course, this is the training ground of the world. If you're not fit in China, going forward in the future, you won't be fit anywhere else. So really winning in China, or at least participating in China, is going to be really critical for all of the global brands.
Every single car maker that I see, whether it's BYD or others, seem to have a Tesla killer. Is Tesla in trouble here as well? FSD, they are trying to sort of supervise launch of that autopilot software. But again, they can't even call it FSD anymore because full self-driving implies you can take off your hands from the wheel. The regulators are concerned about safety. That's a buzzword here. Can Tesla carve out a niche, or can it be a dominant player here?
Well, I don't think we should ever rule out Tesla because of the way that the company is structured and the technology that they're pushing forward. But it's very clear to see that the challenges are here. If we start to look at intelligent driving, just as an example, China, again, as the training ground of the world, the number of vehicles that are equipped with L2, so level 2 driving.
Whereas
really
level 4 would be full autonomy.
Well, exactly right. But level 2 is the way that you can collect all of the data within the ecosystem, allows those vehicles to propagate going forward in the market. And we're seeing that that's nearly double the amount of application as we are in Europe or in the United States in terms of L2 features.
Well, if you look at the leaderboard of new energy vehicles in China, the top 10, 9 of them are Chinese players. And the top 10 make up 80% of the overall market. market. Tesla is the only participant in that top 10, and they only have about 5.6% of the market. So if you look at all those main leaders, led by BYD, they're getting a head start on all the ground truth data that they collect locally, and as well as the desires and wants of the local consumer. So it makes it much more difficult for the foreign players to bring a product into a market where the locals have all the boxes ticked.
I mean, Steve, you make a great point. We recently did a survey of 400 global executives on exactly this topic. And what we found was really that Chinese ecosystem, which is a consumer base which is happy to accept some deviations in software, the access to the engineers, the collection of data is making China really that place that's dominant in terms of driving. And as you say, L2 leads to L3, level 3 leads to level 4, and the collection of that data becomes critical.
And battery charging as well. We've had CATL as well as BYD move markets by simply saying, we can give you 520 kilometers of range in 5-minute charging.
Yeah, it's
That's
incredible.
a game changer as well, isn't it?
Oh, it's a total game changer, because with that technology and then the infrastructure that follows behind it, range anxiety should be a thing of the past.
And battery swapping, Nio is trying to do that. Is that viable versus 5-minute charging?
Well, if the infrastructure exists, then you don't need to swap batteries anymore.
Yep.
But let's see whether we can get that infrastructure, because the requirements on substations and on the whole grid is obviously quite substantial to get that level of voltage through.
Yeah, that's right. Costly. Andrew Bergbaum, thanks so much. AlixPartners.
It's a
Appreciate
pleasure.
your time.
Thanks for your time. Good to see you.
Okay, we're going to send it back to you. Still more coverage, ongoing coverage from Auto Shanghai 2025. Back to you.
Fantastic, Steve. Thank you so much. And if you're one of our Bloomberg clients, you can catch up on all the interviews you might have missed there with Steve, and some of it with us here, of course, on a TV Go. That's a big version on my right. I have a nice little one just for me here on my screens. There we go. Check it out, TV Go. Plenty more ahead, including UBS just slashed their forecast for global growth. Details next. This is Bloomberg. Right, welcome back. Some good news for you guys. Since the tone, U.S. futures are to the downside right now. So just some news coming through out of the folks at UBS. This just dropped, in fact, in our inboxes. I'm going to give you some context. I'm looking for that right now. So they've taken their growth projection down along with other banks. In fact, let me just caveat that by saying the UBS Global Research Team has revised their growth 3 times in the past 2 weeks, but given the current vintage, is how I describe, of tariffs, they now think the global economy will slow from 2.9%, the previous forecast, or most recent one, to the one now, to 2.5% for 2025, right? Now, what is 2.5%? Let me give you some context. 2.5% is the slowest pace of global growth outside of crisis years. 2008, GFC, 2020 global pandemic, 2.5% is the slowest pace of growth in nearly a quarter century, in 25 years. That's context for you outside of crisis years. Effectively, we're looking at possibly the worst year for growth here if things do remain the current settings right now. But yeah, that's just a way of saying the latest bank to cut their projections for the year. Avril.
Yeah, Dave, and I think it's also lower than the IMF's projection for global growth.
Right.
Certainly a lot of trepidation out there. We are also tracking some of these political stories. Separately, we're seeing tensions flaring up between India and Pakistan. This following on from a deadly attack on civilians in Kashmir. New Delhi has decided to suspend a decades-old water-sharing treaty and downgrade diplomatic ties with Islamabad, even though it hasn't yet held anyone responsible. Government reporter Sudhi Rajan Sen joins us from New Delhi. Sudhi, what more can you tell us about the measures that India announced?
Well, the measures that came in yesterday, very clearly India is signaling that it's further downgrading its ties with Pakistan. It's reducing the number of diplomats it had in its embassy in Pakistan, and similarly it is asking also Pakistan to reduce the number of staff. That's at the embassy, the diplomatic level. At the other level, India has also announced that it's suspending the decade-old, it's about 6-decade-old water sharing agreement that India and Pakistan had. It was negotiated with the World Bank, and it was often held up as one of the best examples of how two nations can cooperate in water sharing. What does that mean? It basically means that this halting of the agreement, or keeping the agreement in abeyance, could in the long term affect Pakistan, its agriculture, because millions of people both in India and Pakistan depend on river waters for agriculture. It has the potential to affect that, and that is the signal that this government is giving out. So it's a very, very strong kind of a response that we are seeing from New Delhi in retaliation to the attacks, to the attack on tourists in the disputed region of Jammu and Kashmir.
Yeah. So what then is the response out of Pakistan here?
There have been statements from Pakistan basically saying that Pakistan is not involved in this. That really hasn't washed or been accepted in India. The Pakistan's top security body, which is headed by its Prime Minister, is likely to meet today. And that is where we are likely to get to see what Pakistan's response will be to the measures that India, has announced yesterday. Like India, Pakistan also has several options. We'll have to kind of wait and watch the decision that comes out of Islamabad.
Sudhi Ranjan Sen there, our Bloomberg government reporter in Delhi for us. Right, just on that note here, just some other political stories rather that we're tracking at this point in time. President Trump is ramping up the pressure on the Ukrainian president to accept a peace deal, accusing Volodymyr Zelensky of prolonging the war with Russia. In a social media post, Trump tore into the Ukrainian leader for saying that his country would not recognize Russian sovereignty over Crimea. Now, Trump says the proposed deal would not ask Ukraine to do so.
I think we have a deal with Russia. We have to get a deal with Zelensky, and I hope that Zelensky, I thought it might be easier to deal with Zelensky. So far it's been harder, but that's okay. It's all right. But I think we have a deal with both. I hope they do it.
Now, the U.S. Treasury Secretary has criticized the IMF and the World Bank, saying that the World War II era institutions, both of them, need a course correction. But Scott Bessent also reiterated that the U.S. administration is willing to work with them if they stick to their purpose of restoring and preserving balance in a global economic system.
The IMF and World Bank have enduring value. But mission creep has knocked these institutions off course. Under the status quo, they are falling short.
Now, Chinese President Xi Jinping has blasted an unnamed world power for promoting unilateralism and protectionism. According to Xinhua, Xi says a certain major country has impacted international rules and order. His comments were made at a virtual world leaders meeting on climate action. Notably absent was the U.S., which is the world's largest historical emitter of greenhouse gases and recently implemented tariffs impacting global trade. Right. Plenty more ahead. This is The China Show.
More now to our coverage of the Shanghai Auto Show. We spoke to Bill Russo, CEO of Shanghai-based consultancy Automobility. He says President Trump's tariffs may have far-reaching and unexpected consequences across supply chains.
In the near term, without massive reinvestment in manufacturing overseas. And a lot of that's going to be Chinese companies going global. That's the unintended consequence of slapping tariffs on without a policy that guides investment. Because what will happen is the Chinese companies who dominate that supply chain will start building their factories all around the world in order to avoid the country of origin tariff.
Right. We're already starting to see that as well, you know, the China Plus One strategy. But what do you think those other markets where they can sell these products, end markets like Southeast Asia, like South America, like Africa, like the Middle East, can make up for whatever potential loss that they could have had in the United States?
Yeah, it's sleeves out of your vest. It's volume you didn't have. You haven't sold into the U.S. So you prioritize other markets. You prioritize Southeast Asia, Global South, Africa, Middle East. And by the way, in Europe also, because Europe may have put tariffs out there as bargaining chip, but Europe isn't trying to block China. In fact, there are many European dealer groups here this week shopping for Chinese partners to source electric vehicles from.
What do you think of the rumors or the beginning of the minimum price mechanism to replace perhaps those tariffs that the EU put on them in the first place?
I don't think that, first of all, it doesn't hurt the Chinese company. It actually gives them better pricing. They get better margin. So they don't mind. It raised the floor for us. That means we don't have to fight at the bottom of the pyramid. That means we get better margin. It doesn't do anything. It may give the overseas companies less of a price gap to have to compete with. That's, I think, the logic of it. But the problem with that is it's actually rewarding the company you're trying to slow down with better margins. I don't see how it helps companies get competitive on the things they're lacking, which is the ability to source competitively priced technology.
So on the parts front, I guess you're saying that it's been extremely counterproductive for the American manufacturers because they're not going to be able to source here. You are very close to the U.S. manufacturers. You were the former Chrysler China head, right?
Right.
GM is almost silent here.
Yeah.
Ford is pretty silent. Tesla's not even here again. So what does that say about their prospects in the world's biggest market here?
Well, a lot of the content of what they build, whether it's built in the United States or any other country, a lot of the component technology comes from China. Yeah. China's been inside cars for much longer than American consumers care to realize. They're going to find out just how much cost penalty is going to come as these tariffs roll in. Will that ultimately cause companies to go and consider their supply chains elsewhere? Yeah, sure it will. But that's going to take a long time. It's going to require investment.
What's a long time?
It's going to take years. You don't replicate a multi-tiered supply chain. It's not just moving one part. It's moving all the parts that go into a sub-assembly into a system that then has to go along with that. So it's not building one factory. It's building a whole network of supply chain in other markets. It will happen. There will be regionalization. But a lot of that will have to be Chinese companies investing overseas, which makes them go global even faster. So I don't know if the intended consequence was to accelerate the globalization of Chinese supply chains, but that's what's going to happen.
Yeah, that was Steve there at the Shanghai Auto Show. Just a couple of seconds before we wrap up the show. Session low, 60 minutes left in the morning session. Meituan, JD.com, and other e-commerce names leading to the downside. We'll see you all tomorrow.